Welcome again to my channel. My name is Mr. Kibona, and today's topic I want to share with you about the conceptual framework of public sector. Remember, in financial reporting, we have public sector and then we have private sector. For those who are the first time to listen for me, remember we had another presentation which I did last year, yes. But today I will start afresh so that you get acquainted to this one. What I want to say is why private sector and why public sector as large. So in financial reporting, in reporting structure, it could be either you are dealing with the issue of private sector. So when I say private sector, and then we have public sector, a very simple idea. And then when I say private sector, we are formally talking about IS or FRS. But when we talk about public sector reporting framework, 100% is almost IPSAS. Now, issue is this way. All these issues, almost 90% of IPSAS has been developed from IS. Now, the underlying board in the private sector, we had this board called ISB. And in the public sector, we had this board called IPSASB. So I want to take it from the beginning. So now, in financial reporting, the key issues, how is IPSAS and how is FRS? Let's get started. Actually, in 1977, IFAC was formed, and it was formed on October 7, 1998 in Munich, Germany. And its website is here. And I would like you, professional accountant, to become a member of this website so that you benefit from any updates which are issued regularly according to the board. Now, in 1986, IFAC Public Sector Committee was formed. And that's very important. This committee was formed in 1996. This committee was specifically to deal with issues relating to public sector. Because formerly, issues of public sector and private sector during the world was done at the same time. Things which were confusing. In 1996, a project was initiated to develop more IPSAS under this PAC. But in 2003, the PAC was superseded by IPSASB, meaning the PAC, Public Sector Committee, became the board under IFAC. And it is in this period when more standards in IPSAS were developed. In 2004, most of the standards which are IPSAS, which are public sector oriented, were formed. For example, IPSAS 21, IPSAS 22, IPSAS 23, and IPSAS 24. These key standards are based on key characteristics of public sector at large. Let me add more issue here. What are the key characteristics of public sector? So that you can make it difference from the private sector. And that one will bring out a discussion as to why these standards were formed strategically. The following are the key characteristics of public sector. Number one, we are saying a public sector is highly funded with revenue from non-exchange, meaning the revenue mostly is 90% from non-exchange. For example, we have tax. Public sector collect tax. We have transfer. We have subsidize price. It is in this view IPSAS 23 was formed. That is a special standards of revenue in the public sector. This standard does not exist in the private sector except in NGO. Number two, most of the asset PPE in the public sector are non-cash generating. For example, the military department own military weapons, which does not generate cash. It's not possible to get cash for military equipment. You see, the police, the Ministry of Defense will own some asset which does not generate cash. The National Assembly does not generate cash. So this asset, actually, we call them non-cash generating because the public sector is highly interested to render services. So it will own asset for the purpose of rendering the services. For example, school buildings, they don't generate cash. They are there only for the services. So that's why IPSAS 21 was formed. This is an impairment of non-cash generating asset. Number three, the importance of budget. The importance of budget in public sector will resulted into this IPSAS 24. We have social benefit. Social benefit. That the public sector will always render social benefit to individuals who has social risk. For example, TASAF will classify some households with poverty and provide them with funds. The police post may deal with people with drug abuse. In Zanzibar, all of eldermen, all the people, any person with more than 70 years, he is paid 20,000 per month because of age. Now from here, that's why we have IPSAS 42 for social benefits. So we have a lot of issues that depends on the private sector will have its special standards, and these standards will never happen in the private sector perspective. So my problem was my presentation today. I want to talk on this. On 2008, a public sector initiated a project on a conceptual framework here. So this is where I want to discuss today the conceptual framework public sector, which was initiated on 2008, and it commenced on there. It ends, I think, on 2014, and to date we have now a newer good news conceptual framework. Let me make a timeline here so that you can pick some of the key issues. In the private sector, we have a conceptual framework, the text of 1989, We have the text of 2010. We have the text of 2018. This is the current text which was issued on March. This is how the private sector conceptual framework works. This is how it works here. So now in the public sector, the conceptual framework does not exist anymore. So since 1977, when the IFAC was formed, no conceptual framework were there. Now moving to 2003, when IPSAS-B was formed, no conceptual framework was there. Until 2008, that's when a conceptual framework began. So the project began here, and this project was ready on this one. So it was ready, and to date, we are amending it to suit the benefit of the users. So this is the history of conceptual framework in the public sector. This text we are going to discuss today as to why and what are the importance in itself. So I'll go straight to the discussion so that you can grasp some key issues. This is the documents that explain the conceptual framework in the public sector. And I've taken it from the IPSAS-B and see what happened. So this is when, if we want to read and understand the conceptual framework, this is the key issues. The conceptual framework for general purpose financial reporting by public sector entity in the world. Actually, as you see, these documents, it explains clearly, number one, in the public sector, now can you see, there are how many chapters? There are 8 chapters. And from this discussion, we are going to discuss all these 8 chapters and understand each in each case. During examination, last session, the board examined this question in diploma and IPSAS that discuss the conceptual framework in public sector. So the key issue to set how many chapters and the content on it. So let me go straight to chapter number 1. Chapter number 1, it explains about the role and the authority of general purpose financial reporting. So my discussion today is to understand why this conceptual framework, the content on it, even if you're an accountant or chief accountant or head of finance or somewhere in a board, you must understand the role and authority of conceptual framework. This is within chapter number 1 of the document itself. Let's go to chapter number 1, and you can see some of the key issues, but not very important. It says the preference to conceptual framework for general purpose financial reporting in the public sector entity. But so far, we should be very much aware on our discussion. What is a general purpose financial reporting and what is a special purpose financial reporting? If we could be able to discuss these issues, then it could be very easy for we to go and move. We have not gone to chapter number 1, but I want to pose a definition. What is a general purpose financial reporting and what is a special purpose financial reporting? Let me explain first, because this concept framework is talking about the general purpose financial reporting. And all standards has been issued by IPSAS-B to specify general purpose financial reporting. And we prepare financial statement in the public sector using general purpose financial reporting. Actually, the special purpose financial reporting are the financial statements prepared based on the request of the user. Now, at this point, we must be very much aware and see who are also the users of financial statements. So far, because we are at a discussion, I will summarize some key issues so that when you move and solve and read back, you could get started. Let us see first from this ground. Number one, a user. You see, public sector is here. Now, this public sector could be a central government, or could be a local government or an agency of a government. So this is a public sector at large. Now, who are the users? If we want to notice who are the user of the financial statement presented by the government, for example, the ministry will prepare the financial statements to be tabled to the Supreme Audit, National Audit Department for audit purpose. Why auditing? Because the taxpayers would like to see how much has been spent to render the services. So the user, number one, taxpayer. Taxpayers, people who are paying tax. We call them taxpayers. So the taxpayers pay the tax. So once they pay tax, they expect to receive service. So they pay tax. In exchange, they will see the services. Now, the public sector must prepare financial statements so that the taxpayer will read them. Number one. Number two, donors. Donors are the provider of funds. For example, European Union, the World Bank, the European Commission, and the others. They provide funds to us. They fund the national budget. Donors. They can provide asset to us. They can provide any service to the government. In exchange, the donors will have a condition attached to the transfer. So they have to see financial statements. They have to see financial statements which has been audited by the national audit. If the conditions attached to the transfer has been fully discharged. Now let's see another person here is for example, the National Assembly here. The National Assembly will issue some laws and guidelines to the entity under the government. For example, Talula will receive some money in a form exchequer from treasurer. And the Supreme Auditor, before any transfer from treasurer to Talula, will receive a copy to see if the condition attached to the terms of transfer has been vanished by the accounting officers. So we have these agencies with the governments, which include Talula, TBA, TANROAD, Luwasa, and others. We have these water projects, rural road projects, main road projects, school projects, health projects, and others. All these projects will receive funds from the treasurer through the single account. Now, these transfers from treasurer are attached by specific stipulations. So when the National Assembly approves the transfer through its budget, remember the budget. So the National Assembly will require to see the audited financial statements from these government agents to see if there is a compliance. So the user of financial statements can be the National Assembly, State House. Why State House? State House appoint the accounting officer through its regulations. So if the accounting officer has not fully discharged his or her authority according to Finance Act, actually that becomes a problem. So in particular, I will summary that we have user of financial statements. There are a lot of users. Governing body, the municipal council. As in a local government, we have this municipal council, which will require to approve any bylaws within the council. So it may happen that they approve transfer of funds to certain villages, etc. And at the end, the member of the council will require to see financial statements, which has been audited to see whether the accounting officer was responsible as per those bylaws, etc. So that we have different users in particular. But so far, now, if the donor fund has requested the format of financial statement to be presented, then those financial statements are what we call special purpose financial statements. So if the government or if the government agent is preparing financial statements to respond the user, then those financial statements, we call them special purpose financial statements. If the government agents present financial statements which does not respond the request of the user, then those statements, we call them general purpose financial statements. And what we are now concentrating on this conceptual framework. Okay, let us see from this ground. So I was trying to explain what is a general purpose financial statement and what is a special purpose financial statement so that we can now proceed. So chapter number 1, it explains the law and authority of conceptual framework. So we have these topics to explain here. On chapter number 1, what is the law of conceptual framework and what is an authority of conceptual framework? Let us see. The law of conceptual framework. It is here. Very simple. Very understandable. It said that a conceptual framework for general purpose financial reporting by public sector entity. So he specified general. Okay? Is to establish the concept that underpin general purpose financial reporting by public sector entity that adopt the accrual basis accounting. So the law, the very important of having a conceptual framework, it is because it provides a basis of what? A basis of operation of financial reporting in a public sector entity for those who has adopted IPSAS accrual. Now, the International Public Sector Accounting Standard Board, IPSAS-B, will apply this concept in developing international public sector accounting standard and recommended practice guideline applicable to preparation and presentation of general purpose financial reporting. So actually, as you see, if somebody tell you what's the law of conceptual framework, number 1, we are saying it is there to enhance preparer of financial statement in the public sector to use it when it has adopted IPSAS accrual. Number two, it enhances the IPSASB to apply some key concept when issuing new standards. So in standards, there are two. We have IPSAS and recommended practice guidelines. There are two. So we have IPSAS and this RPGS. Now the authority. Remember chapter number 1, it explains the law of conceptual framework. Number 2, authority. When I say authority, we are saying the conceptual framework has no authority of being a standard. So a conceptual framework is not a standard, it is a framework. Once it happens that we have some key issue in conceptual framework that conflict with the standard, then a preparer is advised to follow a standard. So you see, a conceptual framework does not establish authority requirement for financial reporting by a public sector entity that adopts IPSAS. No, it does it override the standard IPSAS or RPGS. So this conceptual framework is not a standard. So once preparing a financial report, you have to follow the IPSAS, these standards. So if it happens, there is a concept in this document which conflict with any newly adopted standard, then you have to follow the standard. So to explain that the conceptual framework can provide guidelines in dealings with financial reporting issues not dealt with IPSAS or RPGS. So if you have some key issues which does not exist in standards, then you are advised to follow the standards. In these circumstances, preparer and the other can refer to consider the applicability of definition, recognition criteria, measurement principles, and the other concepts identified in the conceptual framework. So as I said earlier, what is a general purpose financial reporting? We have defined it easily. And we can now define the special purpose financial reporting, as I said. So that is chapter number 1. That is, in summary, the chapter number 1. Okay, now chapter number 2. It explains about objectives and users of general purpose financial statements. Objectives and users of general purpose financial statements. So in this chapter, you have to explain what is the objective of reporting. Why should we report? That is chapter number 2. Why should we report financial statements? Number 2, who are the users of these financial statements? So why should we report? We can now explain, but who are the users? Already, I have described here all these users. I said we have donors, National Assembly, we have taxpayers, we have provider of funds, we have the municipal council. We have many users as who request the use of this financial statement. Now let's see here. Chapter number 2, as I said, so that we can go straight. Why should we report? Why should we report financial statement? Actually, we want to provide the information useful for general purpose, for accountability purpose. Because actually, if you receive money to run a district council, for example, then decision making. So we have some operational objectives of the district council. So the provider of fund will make a decision on whether to terminate certain assistant or not. So in order to make a decision, we should provide financial information. So objective of financial reporting is to provide decision, to provide information for decision making. This is how it works. To provide information about entity that is useful to user of general purpose financial reporting to make a decision. For example, who are these users? I said we have many users as the second point here. For example, the tax authority will require a financial report of a local government to see if they have paid withholding tax on goods, service, or on pays. So the tax authority are the user of financial statement to assess if the council has complied with tax laws. The same, the central government or the National Assembly will require financial statement will request financial statement prepared by the TBA to see how the project has been funded during the year. So they will make a decision on the utilization of project funds. So we should first define the user and see how we can use financial statement to make or to be accountability and decision making. In terms of user, we have primary users and secondary users. So I want to go in details here. Let's see the chapter number 3. Chapter number 3, it has some key issues to discuss also. Chapter number 3 of this document explains about what? Qualitative characteristics of financial information. So here from this series, chapter number 1, the law and authority. Chapter number 2, the objective of financial reporting and the users. Number 3, qualitative characteristics of financial information. It has been explained here. Qualitative characteristics of financial information. So in summary, there are 2 qualities. Now, at this point, that's where you need to be very much aware. When I say the quality of information, it's not possible that, for example, the Ministry of Finance has a lot of assets within its reporting structure. It has a lot of transactions. It has a lot of events. But once it prepares its financial statements, it will pick some events to be summarized in a table and present to the supplemental auditor. So it's not possible that you can present all the information in financial statements. It is in this view we need chapter number 3 to define what is a quality of an information to be presented. This is qualitative characteristics of information. What are the issues to consider as a good quality of financial information to be presented? A good quality of financial information to be included in financial statements. Issue number 1 here, we have fundamental quality and enhancing quality. The fundamental quality are these 2. So fundamental quality will include relevance and faithful. The enhancing ones, they are these 4. Understandability, timeline, comparability, and verifiability. These 4. So once assessing the quality of an information, number 1, you have to think its relevance. Number 2, you have to think its faithfulness. Once the information meets these 2 characteristics, then such misstatements is pervasive in financial statements and may attract adverse opinion on audit report, depending on the circumstance. Now, what is relevant so far? So these are issues to be discussed as earlier. So as you see in the public sector, he is telling us relevance in this chapter number 3.6. He said financial and non-financial information is relevant. Now, this is how we make a definition. Very important here. Financial and non-financial information is relevant if it is capable of making a difference in achieving the objective of financial report. So financial and non-financial information is capable of making a difference when it has a confirmatory value, predictive, or both. It may be capable of making a difference and thus relevance even if some of the users choose not to take advantage. Actually, let me explain a bit here. When I say financial informations, are the information which can be presented in financial statements, in a figure, in monetary terms. Non-financial information are not being able to be presented in a figure or monetary terms, but they may be very significant, may be relevance. Now, if we want to confirm, if we want to define the issue of relevance, number one, he said a relevance has 3 factors. Number one, it must be confirmatory. Number two, it must be predictive. Number 3, it must have both. For example, let me talk on this relevance here. For example, if a municipal council, let me see here, a municipal council has provided us with the following revenue. So 2020, 2021, 2022. Revenue collection in municipal council, for example. Revenue. In 2020, it has reported a revenue of 400 million. In 2021, it has reported a revenue of 250 million. In 2022, it has reported a revenue of this million. Now, is this information relevant? So, that is an issue. Is this information relevant? So, if an auditor is auditing financial statements in this year, so he moved comparative in 2021, he found you had this collection. He moved back to 2020, he can see this information. He said, can this information be, is this municipal council predictive? Actually, that's when we can see how the term predictive comes in. When I say predictive, it means you can use information in 2020 to predict the trend of this collection in 2024. As you see this trend, this information is not predictive, and even the supplementary auditor can issue an audit query. What is happening in revenue collection? Either the budget officer is not having enough information to know to make a budget, or the budget officer is not having enough knowledge, or the way it works does not provide a meaning here. So that is how you can say this information is relevant. So that's why you can see on this relevance, an auditor will require to see a financial statement of the current year and on what happened in the previous year. So relevance, the information must be predictive and it must be confirmatory. When I say confirmatory, so predictive is an ability of information to provide predictions of future plans. So the information must be predictive, meaning that it must be able to become an input so that you process information to get an output of the future plans within the municipal council. That is how the information is predictive. Confirmatory is ability of an information to provide feedback on previous predictions based on circumstances which is happening in a public sector. For example, if you have a budget of 40 million in revenue and you have corrected 40 million, then you are saying this information is confirmed. From what you predicted, now in actual results, we have the same. And that's why IPSA number 24 explain about comparisons of actual results and the budget approved. If the difference is material, the accounting officer must explain with the reasons and supporting documents to explain as to why there is a material variances. In this criteria, we are saying the auditor is assessing the relevance of financial statements. That is the term relevance, how it means. So, number 2, we have seen when I say relevance. So, in the actual sense, the relevant information, if you make a decision on a certain item and the way it works, you find it's not relevance, it's very possible that the auditor may reject financial statements. Actually, this is the term relevance. Let me see faithful. So you see, relevance is a factor of 3. Confirmatory, predictive, or both. Very important. Now, within relevance, we have materiality. And the materiality, we're saying, materiality is an aspect of relevance in the form of 2 factors. One, size and nature. We'll see it, how materiality affects relevance in the future. But now let's see faithful. So faithful is a second fundamental quality of an information. So I'm saying to be useful in a financial report, information must be faithful, represented of the economy and the other phenomena that it purports to present. How is this? How is this? To be useful in a financial report, information must be faithfully presented of the economy and the other phenomena that it purports to be represented. Faithfully present is attained when the depiction of phenomena is, now these are the factors. Number 1, complete. Number 2, neutral. Number 3, free from error. Actually, to be faithful, somebody who is faithful, he is talking from his heart. He's not cheating. So to be faithful, when I say complete, what does this mean? For example, if I'm auditing financial statements of the Municipal Council in Kagera, I will see the number of invoice which has been reported in respect of revenue collected. When the all invoice during the year has been presented, then it's complete. So the term complete meaning all the information during the reporting period has been presented. That is the term complete. If I'm reporting fixed asset, so acquisition of fixed asset must have some internal control system during procurement process, starting from turnips. If all procedure has been presented in respect of certain procurement of non-current asset, then I'm saying the information is complete and not missing. So when there is missing payments voucher, then this is purporting faithfulness. This is actually cheating. So you could see the auditor is saying missing payment voucher, unbanked revenue, all that. So when things are missing, then the information of faithful is not there. Neutral is free from biasness. What is biasness? Actually, if you want to prepare financial statements, you should not select the user, or you should not predetermined. So the neutral financial statements are the statements which are prepared not based on predetermined outcomes. For example, people will tend to prepare the statement of performance by creating depreciation rates in order to balance it. So sometimes the balance sheet does not balance. So the accountant may create some fake depreciation in order to balance. Now, those fake depreciation are what we call biased financial statement, and those statements are not neutral because we are trying to balance, to create some of the expenses in order to balance the financial statements. Now, number 3, free from material error. Free from material error indicates what? You have to collect, you have to use appropriate useful life of an asset, you have to use appropriate accounting policy, you have to test for impairment and others. If you have not tested for impairment, or if you have not made your assumption somewhere, then we are now worried with these errors. So having free from error, you have to make best estimate, and this is in IPSA number 3. Those account estimate and the policies are in place. So this is the term faithfulness of financial information in the public sector. So we have done. What is now enhancing? Enhancing, it explains about understandability. Financial statement should be presented in such a way that it is understandable by all users. For example, we are Tanzanian. We have Chinese textile at Urafiki. So we should not use Chinese language to prepare financial statements because Tanzanian, we can't understand them. So the preparer must use a language which is best understandable to the users, to all users, and knowledgeable users. You should use presentation of schedule, presentation of disclosure, so that any person who is reading your financial statements should best understand it, to have this understandability. Timeline. The information must be presented on a time. For example, at every 30th June every year, that's the end of financial year, and before 20th September of every year, financial statement must be submitted to the supplementary audit for audit purpose. Thereafter, there are some series of stages, and as from, I think, April, then they are tabled to the public. So timeline, the information must come on time so that user will have a time to read them and make a decision. So timeline is a quality that financial statements are presented on time. Comparability, it says that comparability is the quality of information that enable user to identify similarities in and differences between two sets of phenomena. Comparing financial statements will mean either within 1 year and another year. For example, comparability, you should present a financial statement of a comparable period of past period so that somebody can assess the relevance of it. So comparability, financial statements are comparable when they are presented using the same accounting policies. And that's why we should have accounting policies which are best being presented. And when comparing financial statements of these entities, must have been reflected by the certain policies which make a basis of comparisons. For example, in Tanzania, we have financial statement prepared under IPSAS. Also, we have financial statements which are yet IPSAS. For example, the government banks are using FRS, while the other public sector are using IPSAS. Now, during comparisons, you can't compare the financial statements of BOT and financial statements of, perhaps say, TBA, because TBA has been presented using ipsa accrual, while BOT has been presented using what? Using FRS. But in different industries also. Now, comparability, it is explaining the way you can compare financial statements using uniformity as a key issue. Okay, so that is comparability. Verifiability. The term verifiability says is a quality of information that help user that information in general purpose financial reporting is first presented the economical and other phenomena that it purposes to present. Actual verifiability, in its term, it is a knowledge, it's a phenomena. It explains that an item is said to be verified if two knowledgeable persons has reached the same consensus. For example, inventory counts at Duasa. You can use two people. The first person can count and reach a certain number. And then you can send another different person or another group to count the same inventory. If the results are the same, then you are saying the inventory has been verified. So that's why from circular number 6 of 2019, it insists that the supplementor must be invited during stock-taking exercise for verifiability purpose. And during stock-taking exercise, the accounting officer must insist verifiability of inventory being counted. Otherwise, it could mean these characteristics. So I've discussed chapter number 3, quality of information in these circumstances. The item materiality, as I said, is an aspect of relevance when it has been expressed in the form of size and nature. So an item is a material or an information is a material if its omission or misstatement could influence the user. So actually, and this materiality had two factors. Number one, it is the size, and number two, it is its nature. How is this actually? Let me explain a bit. When I say size, for example, if you are an accountant working with the university and there is a loss of 100,000 in cash office. So 100,000 in materiality, it could be immaterial to discuss or to investigate. Because as you compare with another, you compare with a volume transaction within the university, the 100,000 is immaterial. That is how size may affect relevance. So you can skip it. If you buy an item which amount 100, or you buy a chair. If you buy a chair, 7,000 shillings, you can't present it in a PP schedule because it is below threshold as per circular directives. So that's materiality as it works. So you ignore it, that this chair will not be classified as PP items in a PP schedule. But if you buy 1,000 chairs valued 7,000 each, then you multiply 7,000 by 100. When you multiply the amount, it becomes almost 1 million. 7 million. So 7 million is material. So when the chairs are in aggregates, when they are one chair, 700,000. Now 1,000 shares, once you buy them all together, the material, the figure in itself become material. Therefore, you take the chairs, you present in P schedule as an item in line in the balance sheet. So you see how materiality in terms of size may affect the relevance of financial information. But let's see size, the nature. The same 100,000 on a chair can be immaterial. But if you buy a bullet, a military gun of 100,000, actually, because of its nature, and if it has got lost somewhere, then it's possible you have to investigate. And this is serious for the accountant in the police station. Actually, materiality in terms of size and nature has to be determined by the entity itself and set the materiality so that it observes the way it works. Even the auditor, once he is auditing and he sees some errors and misstatements, the auditor will always set materiality and sum all small items of losses at the end. When the losses reaches a certain value, the auditor may consider issuing an opinion because of materiality being in form of size and not nature. Okay, now we have done for chapter number 3, quality of information. So let's see number 4. Chapter number 4. Chapter number 4. Chapter number 4. Reporting entity. So chapter number 4, reporting entity. Actually, very simple. In Tanzania, we have who shall report financial statement. So reporting entity is an entity required to present financial statement. For example, in Tanzania, we have TARURA. TARURA is having regional office and even the district office. But during the year end, TARURA HQ will report financial statements for audit. A regional office cannot present financial statement in its own. Another example is the regional hospitals in Tanzania. As from 2018, all regional hospitals in Tanzania become reporting entity. For example, Dodoma General Hospital started presenting financial statements, and all assets were extracted from the RIS. Now, reporting entity is an entity which is required to present financial statements. If you are not required to present financial statement, you are not a reporting entity. So in order to grasp the way it works, for example, you must understand, are you working under reporting entity or under segment reporting entity? So reporting entity in conceptual framework is an entity which is required to present financial statement as it works. So this is the way it has been identified here. And we have key characteristics of reporting entity here. So it's a reporting entity. It is an entity that licenses sources from or on behalf of or constituents or uses resources to undertake activity for the benefit of or behalf of those constituents, and there are service receipt or resources provided depending on a general purpose financial statement of the reporting entity for information for accountable for decision making. So actually, in summary, reporting entity is an entity which is required to present financial statements. Let's see a very good chapter number 5. Elements of financial statements. We have components of financial statements and elements of financial statements. Elements of financial statements will define asset, liability, net asset, revenue, and expenditure. Those are the elements of financial statements. And that's why I said In a conceptual framework, it provides elements of financial statements, its definition, recognition, measurement basis, and the others. So you could be able to see these elements here have been listed. So you can't see these elements in any Oxford dictionaries, except we need to see them in the conceptual framework. So in elements, we have asset, we have liability, we have revenue, we have expenses, and the others. So definition, what is asset? Asset is a resource controlled by a reporting entity as a result of past events. What is the resource? We have now example of resources. So you have to see. Those are the issues to take in. The term control, it explains about legal ownership or transfer, forming treasury, and others. So elements, we have several elements and their definition. All these definitions must be tabled with conceptual framework and not otherwise. So when I say elements, it is over. In the conceptual frameworks, it includes asset, liability, revenue, expenditure, net asset, and others. So those in chapter number 5 is very easy to handle. The issue itself. Let us see the chapter number 6. Chapter number 6. Chapter number 6, recognition in the financial statement. So you see chapter number 6, only recognition. Recognition is a process of incorporating an item of element in chapter number 5 so that have to be included in the financial statement. And that's why we should have some criteria as to which to be incorporated and which not to be incorporated. Now, this factor here is what called recognition criteria. Recognition criteria of any element in the financial statements. An item must satisfy the definition of element. Number 2, the element can be measured in a way that achieves the quality characteristics and that take account of constraints of information. So what he's saying, for example, in order to put the item in a financial statement, it must meet a definition of an element. For example, if it's an asset, it must meet a definition of asset. If it's a liability, it must meet a definition of liability. If it's a revenue, it must meet a definition of revenue. Number 2, he said it must be measured reliably. For example, you can buy a plot of land at Kisasa using local means. And if that plot has not been measured by the municipal council, then you are missing the measurement. Although that plot meets a definition of asset, but it can't be measured reliably simply because the municipal council has not yet established the measurement. Therefore, such plot of land, you can't include it in financial statement in the face. You can put it into the notes that you have a plot of land which is yet to be measured. Now, let's see. We have recognition and derecognition criteria. So far, we should go for the 2 and see the way it works. Recognition is inclusion of item in financial assessments. Derecognition is a removal of an item in financial statements. We are going to see here in a separate discussion on how asset could be included, on how liability can be included. So we have contingent liability, and then we have contingent asset and other cases. So chapter number 5, number 7. So we are from number 6, measurement of asset and liability. How do we measure asset? Very simple. How do we measure asset? Very simple. So asset, remember, we have inventory, we have receivable, you have property, plant, equipment. So there are some issues. You can't present an asset in financial statements without being measured. Again, liabilities. Liabilities, we have the so-called payables, we have accruals, we have provisions, we have contingent liabilities, which are not liabilities in financial statements, and other cases. So as you see, there are different bases of measurements, which may start with historical cost. We have current value measurements, we have market value, we have replacement cost, we have net selling price, we have value news, and the others. Those are bases of measurements, which I can't go into details for today's lecture. I will make another arrangement for you to go. The last chapter is chapter number 8 of this conceptual framework. And remember, during examination, you have to list them and bring down the key issues on how it works. Chapter number 8 is about very simple and understandable, is about presentation. Where do you locate an item? Where do you present current asset? Where do you present liability? The location of item in the financial statements. So remember, there are 8 chapters. You can list them easily and see it how it is useful. But don't forget on making the summary. So before departing on this presentation, I will make a summary for you to remember. For you to remember these chapters for exam purpose. Don't put a lot of things during examination. For example, briefly discuss what is the conceptual frameworks and the scope. So the scope is chapter number 1, chapter number 2, chapter number 3, number 4, number 5, number 6, number 7, and number 8. And a brief, what does it mean? Number 1, the law and authority. Number 2, objective and users. Number 3, qualitative characteristics. Number 4, reporting entity. Number 5, element of financial statements. Number 6, recognition in financial statements. Number 7, measurements of asset and liability in financial statement. Number 8, presentation. Where do we locate? After saying that, I'm sure you can revise it for your examination, either in certificate in IPSAS or diploma in IPSAS, or in any knowledge you base or you need to acquire, or you are the head of finance, or you are in presentation and others. So this is to make the end of this presentation, and thank you for listening.